We are starting a new course that is Finance for Managers. It's a mandatory course.
Ma'am,
Uh,
is this related to the previous one we said, like financial decision, financial
and
accounting? Is it
it's
quite related to that?
not exactly like that, but near to it. It was a bit difficult. This is not going to be that much difficult. Okay. Again, we are going to have financial statements in it. And although, Alhamdulillah, you people are known about these terminologies, I just remembered that you were in for level 4 as well. So in total, we are having 3 learning outcomes for this course, and there are specific assessment criteria. And we already know that we need to only use the indicative content points today. Even for AC 1.1, I have used these points only for the sources of finance and types of organization. So I'll let you know how we can deal with it. Then we have the assignment as well for this course. Okay, we have task 1 in it, which is from LO1. Then we have task 2, which is from LO2. And then we have task 3, which is from LO3. So you can see it by your own self. This is not exactly like your LO4 course, Financial Management Accounting Techniques. So that we needed to do
Hmm.
the calculations and everything. In this, we're going to make different charts, and the calculations are going to be there, as you can see, break-even calculation, but these are very small calculations, like formula. We need to only add the numbers in it, and you will get the solutions. And side by side, with the respective assessment criteria, we are having the suggested evidence. This helps us a lot to write the answer. This is the breakdown of assessment guidance. I write OD. Simply in this course, what we're going to do, we have to focus on the learning outcomes and assessment criteria throughout the assignment brief. Then we need to use the real life example. And again, the contradiction is that we need to stick to only small, medium enterprise. Then some parts of the assessment require information from the named or chosen organization. Again, it is going to be an SME. Where you feel like you can give general example, go ahead for it. Then use of actual financial information, that is, we are going to extract information of various organizations for financial projects, most probably NPV, financial statement including the income statement, statement of financial position, and change in equity. We will see if we need that. And organizational cost information, what will be the update in it. This is for you people, for your help. Like if you feel like you did not understand any terminology in between the lecture, or you feel like more depth to any part, there are 30 words which are used in 2 assessment criteria today, the important one, and you can definitely read up the definitions for it. Okay. Simply, what is finance? Starting the course. Finance is the management of the money and other financial resources. It includes activities like budgeting, saving, borrowing, investing, and forecasting future financial performance. Finance is all about the money, but it can be in any form. Sometimes in liquid form, sometimes in different various investments. Then finance helps individuals, businesses, and governments make informed decisions about how to use their money wisely. It ensures that there are enough funds available for the operations, growth, emergencies, and future planning. That is, sometimes there is literally a natural catastrophe, and we need to use up the reserves. So we must have enough money at the back as well, and in the presence of management too, in the organization, basically. Then what is actually finance for managers? Your course topic. Finance for managers refers to the financial knowledge and skills managers need to make informed business decisions that improve performance and profitability. So we are going to use different statements in it, but specifically it is for the managers, which requires certain kinds of techniques and skills through which they pursue their work with the subordinates and the colleagues. Managers, even if not working in the finance departments, must understand, like this is the obligation for every sort of manager, whether you're an MD or a frontline manager, how to read and interpret financial statements. Everybody should know who is in the organization and in any position how to deal and tackle with a statement of position, financial position, income statement, and so on. How to manage the budget and costing. It's really important if we talk about the marginal cost, absorption costing. You people did calculate it in your LO4 course as well. It's not easy. It takes time and it's technical too. How to assess the financial health of the department or company, how we can see whether we are improving or not, how to make decision based on the cost benefit analysis, CBA, an important aspect in each and every business, whether it is an SME or whether it is a big company, a big organization. Cost benefit analysis, we always want more return rather than applying our more money. How to evaluate investments and control cash flow. Evaluate investments wherever we are trying to pursue with the investments or we're going to go for the merger or acquisition. We need to conclude its strengths and weaknesses, or we can apply the whole SMART concept, specific and measurable one. And then how to control the cash flow, inflow and outflow. Always we want inflow must be in the positive number and outflow must be in the a negative way. Less money should go outside the business. Is finance for a
So,
manager?
ma'am,
Hmm?
finance for managers mainly known for the like you yourself making, like improving the performance, you yourself calculating. For the managers I'm talking about, they will manage the budgets, cost, and everything.
But surely they are going to manage everything other than the finance manager. Uh,
Hmm.
we should know the concept. If we are in the organization and if we're in the position of a manager, they should know all the interpretation of the finance. It's mandatory for them. LO1 1.1 assessment criteria describe the sources of finance available to different types of organization. Sources of finance in the indicative content, the heading is available, and even the types of organization is given there. So there are two headings in one question, and we are going to write it up. The command verb is described. We are going to follow it. That is, provide an extended range of detailed factual information about the topic or the item in a logical way. I tried my best to add examples from Saudi again, just to make sure you can actually relate it with the reality. The first, sources of finance. Basically, we are clear that what finance is, in the short, it's money in the various form. Then there are sources. Sometimes it's internal, sometimes it's external, sometimes it is short term, sometimes it's long term. And even the primary and secondary, there are so many types. Let's read it. Finance generated from within the organization, not requiring external borrowing or investment. That is, you're not taking the money from outside the company, outside the business. You're not asking the banks, you're not asking the agencies, nor your competitors. You're doing it by your own self. Types and explanation, retained earnings. Under the internal sources of finance, the first thing is retained earnings. What it means, profits that are kept in the business rather than paid out to the owners and shareholders. Reserves as well. Retained earnings, the word is reserves, the money which is used only for the any problem occurs in the business. So we have enough finance in the business as well to cover up that cost. Sometimes we allot a budget, for example, 50 rupees, let's say, but we were not able to complete a project in 50 rupees. So what will happen? If it exceeds to 70, that 20% increment is going to be fulfilled by the retained earnings or the reserves in the business. Then we have sale of assets. What it means, selling the unused or non-core assets like machinery or property to raise funds. Non-core assets, sale of assets, your non-current assets. The investments in which we have done in different kinds of machinery, different kinds of properties, in which we calculate the depreciation, they can be used for the money purpose when we don't have it. In when there is a need, we can sell it out as well. Owner's capital, owners, where is the stakeholder, the entrepreneur. Investment from the business owners, commonly seen in sole traders or partnership. The businesses in which only he is working and he is the boss and he's the worker as well, that is the sole trader. And if he is applying his own money in the business, that is known as owner's capital. Same goes for the partnership. We give few amount of money to everyone, like maximum the partnership goes with 20 people, and then things goes on. For example, Al Muajil Co. A Saudi company, a Saudi family-owned business, reinvest profits from one division into expanding another. For example, they use retained earnings, their own earnings, to launch a logistics arm without external funding. So what they're doing within the business and like within their working operations, they're using their own money and they're trying to expand it. Like there are so many small schools in your area, like Apple Seed School, even in Medina. They have no other branch other than one. But again, whatever they earn, the retained profit or the reserve, they do utilize it for the skills, for the techniques the teachers needs to learn. They do that. External sources of finance. Finance obtained from the outside the organization, including the individuals, banks, microfinance, or institutions. We are taking it from outside now. The types and explanations for the external sources are the first is bank loans. That is medium or long term funds borrowed from the banks at an interest rate. It could be 2%, it could be 3%, which is actually haram too, but we do it because that is how the business run. Trade credit, the loan system. Trade credit, buying goods or services now and paying later. That is the relationship of producer and supplier as well. You take the raw material, you take the goods to manufacture it in a product, but what do? You pay them after 30 to 60 days. Leasing, renting an equipment or property instead of buying. Many people, they do not buy the property or a workshop, they just rent it out. Venture capital, investors provide capital to small businesses in exchange for equity. What is equity? Any idea? You people did the course in level 4 as well.
Ma'am, is it about their significance of the financial management, like shareholders or business, like total assets or total liabilities?
You're near to it. Basically, equity is an asset, but again, it is in terms of brand image as well. You're getting goodwill too. Crowdfunding, raising small amounts from a large number of people, often online, like we do in the form of donations. That is what, that is a crowdfunding. Like you can take the recent example, we are raising up the funds regularly for the people in Gaza. That is a best example for crowdfunding. For example, Salasa Saudi e-commerce fulfillment startup secured venture capital from the local investors such as Raid Ventures to expand their operations across the kingdom. So what they're doing, they are taking capital from the venture capital, another established firm, and then they're working on themselves. Short-term sources of finance. Finance needs or for the less than 1 year to manage cash flow or meet immediate needs. Short-term in any terminology, it means less than 1 year. It cannot exceed more than a year. Long-term loans, benefits, finance, or any even asset, they exceed for more than a year. Now, for example, overdrafts. What are overdrafts? Bank allows business to withdraw more than it has. And how it happens? Without making it to the knowledge of the people who have bulk amount of money in the banks in their accounts, they start to grasp it by own self. That is how the whole mechanism of bank work as well. This is the reason we take interest rate as well. Trade credit, short-term loans. Trade creditors, again, we are buying up the stuff, but we are going to pay it afterwards. We're enjoying the amenity first. Then short-term loans, less than a year. Example, the Mimi Market's a local supermarket chain. Is it even exist? You need to tell me as well. Like you people have been out to. This is like that. It uses trade
Ma'am,
credit
can
from
you?
suppliers. Yes,
Yeah, they do. They do. The Mimi markets, they gave us a
because I
card, but
haven't
about the
experienced
credit,
it.
yeah.
It uses trade
Even
credit.
they even
Hmm? Yeah, yeah.
No, like Tamimi, if you're talking about the one you just heard, they do. They take like they uses credit from suppliers to stock some goods. Like as usual, you were talking about Ramadan packages, they do actually. They I think for Ramadan packages they do every year. Like maybe all the supermarkets, but for Tamimi's one, I have no idea for that.
It uses the trade credit from the suppliers to stock seasonal goods like Ramadan packages without immediate payment. Now, I think the concept is clear that what trade credit is. Enjoying the amenities, paying afterwards. Medium-term sources of finance. Finance for 1 to 5 years, often used for the purchasing equipment expansion or product development. Purchasing equipment, you want to add up more machinery. Asset expansion, expanding up the business, going for the merger or acquisition or conglomerate. Or product development, you want to make it better. In
Ma'am, if you don't, sorry, ma'am, can you repeat once again for medium-term sources of finance because it's here given like finance for 1 to 5 years. Like for
yes,
I
it
didn't get
more
that,
than
ma'am.
a year, but the limit is
Yeah.
5 years. Okay? It won't be less than 1 year. It will be exceeding 1 year, but the limit is 5 years. So you're having two, three, four, total maximum 4 years to cover it up the cost. The first is bank loan. They are not for 2 months or 3 months. They are for 1 year, more than a year, and maximum 5 years. Then leasing, using up the machinery, the asset, and then you can pay it up afterwards. Hire purchase, paying in installments over time, like property dealers. They do this. Maybe the boys know about this thing. We do this in Pakistan as well. The lease payment and the hire purchasing and the installment. But with the passage of time, the thing gets yours, but it takes a lot of time. Like in
Yes, ma'am. Like for example, if you buy a different property, especially car, mostly car or any electronic device, if you buy, like which is
yeah,
the
I was about to take the example for the electronic device. We never knew that we can get the iPhone on the lease payments as well. But
yes.
we got to know that it's okay. Why everybody is having iPhone? Because they are paying more money afterwards in the form of installment. For example, Nana, a Saudi online grocery platform, the known as well, leased delivery vans to scale operations during the COVID-19 boom, reducing the upfront costs. That is, the frontline costs are going to reduce because of this thing. And long-term finances, see it is more than 5 years, but it is again, in many of the business cases, it is above than 1 year, and then the limit is to 10 years. But here it is clearly written, it is for more than 5 years. It could be any. Typically used for infrastructure, that is building up a hospital, school, any building, expansion or large-scale investment. Now, it's not going to be in thousands or hundreds, it's going to be in the millions and billions. Equity financing, what it is, selling the shares of the company to investors. This happens when your company is at the stock exchange and you're not able to fill up the requirement, you're not paying up the dividends in the form of preference and ordinary shares to the people who hold it, then what you do, you try to just sell out the shares. In that way, people buy your shares and you're free for any debt and everything. Long-term loans, again, they are for more than a year till 10 years. Bonds for the larger firms, though it is haram. I never knew about it. We used to buy it as well, but it is considered as haram. We cannot buy the bonds. Example, Saudi SME, Jahiz, I hope it is pronounced like this, a food delivery
Yeah,
taxi.
ma'am.
It
Jahez,
is
yeah.
the words are quite difficult to pronounce, I feel like. You need
But
to.
this Jahez, even ma'am, even Jahez also pronounced in another way. I think they use this even Hindi as well. Hindi and Urdu, they use this as well. The
Okay.
word.
It has raised long-term capital through the IPO. This is not known as initial public offering to expand beyond Saudi Arabia. Initial public offering was when you have to list up yourself, your company at the stock exchange. Let me just recheck from the definitions as well, because I don't want that we have something wrong. Initia. First time a company offers its shares to the public to raise long-term capital. Yes, we are listed at the stock exchange for the very first time. That is called initial public offering. Now, these are the types of organization. I said that first we are done with the sources of finance. Now, moving towards the types of organization. We have the type, we have suitable finance, then we have the explanation, and we have the examples. The first type is sole trader. Sole traders, suitable finance is what? Owner's capital, like the person, the owner, the entrepreneur, the worker, everyone, he's the one entity. Bank overdraft, trade credit. Through these things, they get up the finance. Then limited access to finance uses the personal or family funds. For example, a home-based Saudi bakery uses personal savings for the ingredients. Then we have partnership. Partners, capital, bank loans. Through this, we gain up the finance. Shared resources, banks more willing to lend than a sole trader because you are shared up now. You have more capital, you have more investment with that. Even if your business is not successful, it has been failed, the risk is going to be divided as well in the partnership. Saudi SME, a small law firm in Jeddah, takes a medium-term loan to open a new office. More than 1 year, maximum 5 years. Private limited company Ltd. Retain earnings, your own savings from the bank, from the business, bank loans, leasing. It can raise more finance protected liability because it is saved. That is why. Manufacturing firm in Dammam leases the machinery for the expansion. Like the contract, not the contractor, the tractors, the different machinery used in the construction site work, they are leased mostly. Public Limited Company PLC, equity, capital shares, bonds, IPO, initial public offering. Through this, we do the financing. Can raise substantial capital from the public as well because obviously you're listed on the stock exchange. JHIS raised over the SAR 1.6 Saudi Riyal billion in its IPO, initial public offering, for the very first time. Third sector organization, non-profit NGOs. These are run on grants, donations, and sponsorship because that is how things work for the NGOs only. Finance depends on the donor goodwill and government support. Donor's goodwill, that is the person who is actually donating up the money from different and various sources, what the reputation is. A charity in Riyadh receives funds from the government grants and zakat donations. Understanding and selecting appropriate sources of finance is crucial for the business sources. Each organization type has unique assets and requirements, so the SMEs demonstrate a use of both internal and external financing depending on their structure, growth stage, and strategic goals. Now, it doesn't depend on only Saudi SMEs, it is for every kind of SMEs, but we need to see the culture as well. That is the constraint, that is the drawback as well. How the structures are of various organizations, what is their growth stage, whether it is at maturity level, saturation period, or they're just booming up, and strategic goals, their organization, vision, and mission goals. Evaluate the costs and benefits of different sources of finance. Again, we do not have proper points for this assessment criteria in the indicative content, but what I did is that for the sources of finance heading, the long-term, short-term, the medium, I use the same and we are going to evaluate it now. Evaluate means to add up the strengths and weaknesses, suggested similarities and differences, judgment, conclusion, or recommendation. Finance is essential for starting, operating, and expanding any business. You need money for it. Selecting the right source of finance is critical to ensure sustainability. That is, your business is going to be prolonged for a very large period. Profitability, more profit, more money, and controlled risk, the problem associated with it. This AC evaluates the cost, benefits, similarities, and differences of various internal and external, as well as short, medium, and long-term sources of finance. Real-life examples from SME in Saudi are used to illustrate these. Evaluation of sources of finance. Internal sources of finance. Funds generated from within the business, such as retained earnings, sales of assets, or owner's capital. We just did this in even 1.1 as well, but the words are different. The concept is same. We're going to do it with the, what do we call that? Through the change of command grip, that is evaluate. Strengths are no interest or repayment required because there is no need. Full control remained with the owners, the entrepreneurs. Quick access and flexible use. Whenever you need a finance, you can use it within the business because you are the owner for it. However, limited availability, especially in the startups or during losses, because when you are a startup, you're a sole trader. How you can think you can have enough reserve? You cannot have it. May restrict growth if overused. Because if you're buying up the supplies or more and more material and you're not working on your infrastructure and expansion, things are going to be complicated at the end. Selling assets may reduce operational capacity. Like you are like it's a natural norm for you people that you're selling up the non-current assets regularly, the machineries, the things associated with it, then it will cause a lot of problem at the end because machineries are expensive too. And if we buy second hand as well, we need to go for a lot of reparation. For example, Al Mutlaq Furniture, a family-owned SME in Saudi Arabia, reinvest the profits, retain earnings, or the reserves to open the new showrooms without taking the external loans because they've been up in the business. That's the reason. External sources of finance, funds obtained from the outside the business, such as bank loans, venture capital, or crowdfunding. We did this right now. Strengths are basically the main focus is going to be mine on the strengths and weaknesses at the moment. Larger amounts available than the internal sources. That's true because the reason is we have more source of money now. Enable rapid growth or the large investment. When you're external and you're financing money from outsides, you can grow quite quickly. Build credit history if repaid on time. Credit history means the banks will obviously see your statements. If you're paying up the loans in timely manner and with the proper interest rate, they're going to give you again as well. However, it may involve interest, repayments, or loss of equity control. That's true. Liabilities are going to be missed at the end. Repayments, it's not easy. It has a lot of cost, and even interest is also added up to the volume, to the money volume which we take the loan from the different what do you call that sources. It requires formal application, security, or quantilateral. What it is? Formal applications, proper, work is being required to grant up the loan. Until and unless you cannot pursue with it. Security, the other word which I cannot obviously say in Urdu, maybe you people know it. Whenever we buy a loan from a bank, we need to give a security. It could be the papers of your house or the building for which you are taking up the things. Then collateral, a proper bonding or a banding of different people and sources together, just for the capital's sake. Adds financial risk if not managed properly. Financial risk, if you're not paying up the payments in time, they can just close up or seal up your business to the banks. For example, Sari, a B2B business to business Saudi wholesale startup, raised capital from the venture capitalists like STV to expand its logistics and inventory system. So they're buying from another source just to expand up their own business. And even the venture capitalist or the capital, they're enjoying a lot because they charge you high. Short-term sources of finance. Finance required for up to 1 year, mostly for working capital or emergencies. Sometimes we require small amount of loan, so it's very easy to get it from the banks, but from the different sources as well. But it's not for all the time, or it's readily for everyone. Example: overdrafts, trade credit, and short-term loans. We did discuss this. Strengths, fast access and flexibility, it's easy. Ideal for managing temporary cash flow gaps. If there is a lot of gap in inflow, we can fill up that. Usually unsecured, for example, paid credit, because of maybe the supplier, they are not willing to give you more supply if you're not paying them the timely purpose. However, high interest rates, especially for the overdrafts. Why we have high interest rate for the overdrafts? Because overdraft itself is not like a normal thing. We're taking huge loans from the banks. Frequent renewals increase admin burden. Why? Because you cannot stick or change the policy so soon after 2 months or 2 weeks. Stick it to it for like 6 to 8 months maximum. Risk of dependency or short-term fixes. Why there is a risk associated with the short-term fixes? Because it will increase your operational cost or daily expenses. For example, again, that the Mimi Markets, a Saudi supermarket chain, uses paid credit from the suppliers to stock high demand items during the Ramadan. The example is same, but in different concept, just to make sure that how the concept of paid credit works. Finance for 1 to 5 years, used for asset purchase, branch openings or the brand openings, or system upgrades. You're changing even the organization structure of your organization. For example, loan, leasing, and hire purchase, things were discussed earlier. Strengths enable the manageable repayments over time. When you're going to work properly on your medium term sources of finance, you're going to manage up the repayments as well, because it's really mandatory to overlook when and how to pay things with the interest rate attached. Suitable for growth and capital investment because you need to pursue within the business and market, often secured with fixed interest rates. Many banks, what they do, they even fluctuate the interest rate with the economy and the dollar appreciation and depreciation. That is also very bad. But this is how the whole mechanism works. However, requires credit checks and collateral. That is again and again, you need to see whether you're able to repay it or not. Fixed repayment schedules reduce flexibility. Why it reduces flexibility? Because you're bound to pay it in that fixed date and time. Leasing may be more expensive than owing. That's true. When you lease up a thing, it it's we feel like that it's not expensive at all, but if you accumulate all the amount, it is quite high. For example, Nana Direct, an online grocery platform, leased vehicles to expand delivery services rather than buying them outright. Once they establish themselves, then they buy it, like bought it. But before that, they were working on the leased terminologies. Long-term source of finance. Long-term sources of finance there for more than 5 years. And what strengths and weaknesses are large amounts available? Yes, a big amount, bulk amount, prepayment periods are longer, easing up the pressure. Obviously, when you take large amount, they're going to not tease you at all. Everything is going to be easy for you people, useful for strategic planning and expansion. Now, this is on the on the big scale. It's not on the small scale, not for the sole traders or partnership. It is for the international businesses. However, equity financing can dilute the ownership and control because if one company faces a loss, a partner faces a loss, it can sue you up as well. Loans incur interest and require collateral. Again, we need a proper agreement for each and everything, and that's a big weakness as well. What if one partner is not signing up a document? IPO's initial public offering are expensive and complex, but again, because it's a public limited company, it's a big company, it's not going to be a problem at the end. For example, Jahez, a Saudi food delivery SME, raised over the Saudi Real 1.6 billion through an initial public offering on the full stock exchange to fund regional growth. Now we have comparison analysis, that is the similarities and differences, type, internal versus external. Similarities, both fund, this is how you explain it in your assignments too. First, explain all the points, their weaknesses and strengths, and then collectively you can
Ma'am, if
differences. Yes?
are we going to make tables in our assignments like this? Like, are we going to make a table like this while we were doing
No,
our
we're going to write
assignments?
in paragraph. This
Yeah.
is a presentation, that is why it is a scrutinized way.
Oh, okay.
Internal versus external similarities are simple, both fund operations or growth. Difference is no interest or control or loss for the internal because they have nothing to lose. And external higher amounts, but risk in past. It's risky. Short versus long term similarity, both are planned forms of funding. That is, first you need to plan when you can repay, where you need to use it, then we can opt for it because we take loan from the bank for this type. Short, immediate needs, higher cost. For the long, we have strategic investments, lower cost over time. Why it is lower cost over time? Because obviously you gain the profits too. Medium versus long term used for growth and expansion when you want to go for the merger or acquisition, conglomerate, or even diversification, or going from national to international business. Medium assets system upgrades for the long expansion infrastructure IPOs initial public offering. That is why this is the big major differences as well between the types of sources of finance. Judgment. While internal finance is cost effective and low risk, it may not be sufficient for the ambitious growth plans. Why it is not sufficient for the growth plan? Because obviously we are like it's a restriction, it's a mitigation that we can only use the finance within the business. External sources provide scalability but carry the cost and risk. Scalability, we have a large amount of money, but what it requires, a lot of interest rates and strings attached to it. SMEs must balance the control repayment ability, how we are going to repay it, and growth needs, how they are going to go further ahead in the industry. For most of the SMEs, a mix of retained earnings internal or the reserves internally and medium-term loans external. Why? Because we take the loans from different sources, offers a realistic and flexible financial foundation. Recommendations use internal sources for small expansions or the operational improvements like for the daily expenditures too. Use trade credit and short-term loans to manage working capital cycles. Working capital cycle is all about the assets liability. That is what it is. Not that is what it is. This is how it works. And in trade credit, we are enjoying the amenities and we pay afterwards. Leverage medium-term bank loans or leasing for the machinery and tech upgrades because it's mandatory for the banks and the microfinancers and the sources too that they should at least like make it easy for us so that we can take the loan, we can work for it, work for the purpose easily, like the farmers it was not easy for them to take the loan from the banks. That is why microfinancing started. And now they can take the loans on small lease and they can buy up the tractor. Seek long-term equity funding or the IPO only when expanding nationally or internationally as seen with Jahez. Only then you can go for this because it has a lot of strings attached to it. Strings mean limitations. Always evaluate cost of capital, what the capital in any form, money, bonds, loan you're taking from the bank or any source, what will be the cost? What will be the sources attached to it versus expected returns before choosing any source? Now I'm taking a loan of 100 rupees and I'm not even generating 200 rupees. Then what's the cause of taking the loan then? Conclusion, there is one size fits all sources of finance. Like every company needs to offer different sources of finance, like types of organizations do, structures too. The best approach involves combining different sources based on the company's size. Again, sole trader partnership, SME, public limited company, goals and risk profile. Some companies they are only happy to provide the audience with the niche commodities, but that's not with everyone. We need the basic amenities too. For SMEs,
Why, ma'am, not for,
yeah,
sorry, ma'am, why not for everyone? The commodities we were talking about, why not for everyone? My
um,
question is,
not everyone wants to buy the bag from LV, Louis Vuitton.
oh,
See,
oh, okay.
they have a niche market. They know that these people are going to buy, and no matter what, they are going to sell the commodities to only them. Not everybody is interested either. For SMEs in Saudi Arabia, especially those in the growth stages, which are striving actually, internal reinvestment supported by selective external borrowing. That is, they are going to use their own money as well, the one which they have generated, after paying all the salaries, expenses, rents, everything. They are going to use external borrowing as well, offers to most sustainable path. That is, they are going to be in the business lane for a very longer period of time when they're going to use both things wisely and side by side. So that's it. This was our first lecture for the course Finance for Manager. We completed 1.1 and 1.2. Those specifically who joined late, I tried my best to demonstrate in the next assessment criteria, but you can always hit up the recordings too. It's not difficult at all. Just it's not like your LO4, not LO4, your level 4 course, the Finance for Manager one. It's going to be easy. Any question, any query, you can ask now.
Ma'am, my question is about the one you just we have to choose the particular SMEs so that we can just go through about the finances for the managers and everything, like long term, short term, because as you have explained about the leases and everything.
We cannot go for the particular SMEs because SMEs
Hmm.
cannot go with large loans. They cannot go for the IPO, they cannot go for the medium term financing, nor the long. They're going to
Yeah.
stick with the first two that were short and afterwards what it was, the other point, like the second point. Because you're already SME.
Hmm.
You're a sole trader or you're going to
Yes.
have one or two partner least.